Wow, the year is rapidly rolling by. So we're going to make sure that you've got on your to-do list something that you need to be doing prior to your year end if you're a particular age. Of course, what we're referring to is your required minimum distribution. So we will be talking about that on this week's episode of Dollars and Cents, along with a option that you have as it relates to the deed on your house to perhaps avoid the cost and expense of probate just by changing the registration ever so slightly using the ladybird technique on your property. So all of that on this week's program. Welcome, of course, into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top financial planning podcast out there on the big wide world web. So make sure you subscribe to us on your favorite podcast channel or visit our website at Nelson Financial Planning to learn how you can connect directly to us. My name is Joel Garris, a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who stand ready to help you make better decisions with your money at any point in time. All of them are certified financial fiduciaries as well, along with having a field of expertise, whether it be about Social Security or taxes or what have you. That's all part of the team at Nelson Financial Planning. Next week on the program, I'll be joined by Christina Lamb on the program. This week, of course, it is just me, so we shall roll along. And one of the things that I wanted to kind of talk a little bit about is a little trip that I made just recently up to Washington, D.C. So it was a national conference. Obviously, having the opportunity to go to a bunch of these things. I only actually go to one, and this is the one that I go to. It's kind of a relatively exclusive invitation only to about 100 people around the country. And the reason I kind of carve out the time to go to this one is that it actually does provide some interesting insights. You know, a lot of these conferences that you attend in life are very much about kind of sales and products and things like that. You don't really kind of walk away with really a whole lot of additional insight and information. But this one I typically do, and which is why we typically try and make sure that we make it. It's hosted by one of the world's largest investment managers, manage about well over $3 trillion. So an opportunity to kind of hear directly from portfolio managers, economists, leaders in the business to just kind of gain some perspective and some insights. So I thought it would be interesting to kind of start the program with sort of some of the things that we learned that you might be able to use as it relates to your own personal finances and investment allocation. So, as you might suspect, a lot of the conversation was about AI, right? I mean, it's hard to kind of avoid that. But, I guess the question to also ask is, are there some cautionary flags blowing in the wind on this? And I think if we think about technology and the rapid adaptation of technology that we've seen over the course of the past 50 years, there's this tendency when something new comes online, as it relates to sort of the future demand, I think there's a tendency to sort of overestimate that impact or what that future demand might be, kind of more in the short term. So there's that tendency to kind of overestimate what it's going to look like within the next 2 years, but yet sort of underestimate what that longer term picture looks like over the course of the next 10 years. And so if you think about technology and you hear so much about it and so much excitement every time sort of a new technology kind of comes out, but sometimes that overexcitement is misplaced in kind of the shorter term, maybe not so much in the longer term, but certainly in the shorter term. And, if you think back to the 90s, I think there are some parallels. And the question that came up at this conference was, are we sitting in the year 1996 from an adaptation of technology perspective, or is this the year 1999? And obviously there's a big difference between the two. Let me sort of paint the picture of what was going on during that period of time. If you think back to the 90s, right, it was the internet. That was something that was going to fundamentally change the world, and it certainly did. Can you imagine life without the internet now? I mean, it's kind of crazy when you stop and think about it. And the reality is, though, in if you think to 1996, there was still a large build out, still ongoing, and continued to go on for a few more years till you got to 1999, and then then that all kind of stopped because the build out wound up being too much and excessive, and then you had sort of a reset. So sort of that classic over sort of estimating what you might need in the next couple of years or so, but certainly underestimating that the internet became basically ubiquitous throughout our lives over the course of the next decade. So thinking about kind of that and sort of how this pattern with technology, particularly significant technological interruptions, sort of all kind of play out, or how they played out in the past. Throw against that backdrop, about a week ago, there was a Financial Times article talking about some of the circularity of transactions among all these different AI companies. Like, you got one company, buying product from another company, and then that company's turning around and investing money in that company that just bought product from it, right? So that, as you might well imagine, that kind of a little bit of a circular transaction. And that certainly was the case, back in the late 90s. Lucent Technologies was a great example of that, where as a vendor it was loaning out tons of money to encourage other companies to install fiber optic cable. And so Financial Times article about a week or so ago kind of started to delve into that and think through that and start to see some similarities in terms of what's happening with AI. And then lo and behold, just this past week, Wall Street Journal did a similar article on that. So much like you saw in kind of the 90s and the installation of fiber optic, I mean, is there the potential that there is some creation of overcapacity, if you will, that's happening right now as it relates to the to AI, and obviously time will tell as to whether this is 96 or 99, but certainly something as an investor that you need to kind of be aware of these particular patterns. Because obviously the impact of AI, you don't need me to tell you this. It's certainly pretty significant. It has significant impacts in everything that we do. Impact certainly on the labor market. Much more of perhaps an impact on white collar jobs and less so on kind of blue collar trade type jobs. There's certainly a lot of onshoring happening by companies where they're bringing, manufacturing back, things like that to this country. But when you start to kind of look at what's actually happening, a lot of that onshoring is actually being done by robots that use AI, not humans. So, certainly an impact in the labor market, and certainly a societal impact, significantly among younger generations. A number of studies that suggest that AI is unfortunately causing despondency and creating negativity about the future in the younger generations. And honestly, to be candid, I mean, obviously, if you're regular listeners to the program, I have 3 young adult sons in their early 20s. And I think I would agree with that. There is a little bit more of a negativity of the future. And certainly some of the studies would suggest, hey, that's, kind of the impact of AI. Just some thoughts on all of that. We've got some additional thoughts as well, along with like 3 other themes. And so this is important. And so we want to continue the conversation here. So we will take a break here on the program and then return after these messages. So stay tuned for more of Dollars and Cents with Joel Garris of Nelson Financial Planning. So in the first segment, we were talking a little bit about the national conference that I just recently attended. It's the only one I attend because most of them are all just products and salesies and a bunch of nonsense. This one actually, I always leave with a lot of interesting insights into kind of what's going on from an investment perspective, the markets, the economy, all of that. And so very unique, kind of a invitation only, about 100 people around the country, come on in for it. And this year just happened to be held in Washington, D.C., which was obviously interesting in its own right. And so we were talking a little bit about, obviously, the big topic, AI, and so we kind of talked a lot about that in the previous segment. Certainly, major impact. But I think the real question is this: if we think back to the internet, which was obviously a transformative technology, much like from every indication that AI is going to be. But the question is this 96 or 99? And you want it to be 96, but if it's 99, you still need to kind of be prepared, particularly from an investment allocation. And the reality is we don't know where we are, whether this is 96 or 99. The impact on society is certainly pretty significant. Obviously, if you're a regular listener to the program, and we've talked about this, we certainly use AI at the office. This past week, we usually as a team, kind of meet on a regular basis and, kind of share how we're using it. Because I think everybody's experience and how they use it is different because it does have so many different things that you can do to do with it. And obviously in our case at Nelson Financial Planning, we've been using it a lot, for several years in terms of our tax preparation, our tax return preparation software. But, the key thing, as we were talking about earlier, you really do have to overlay critical thinking skills on this stuff, right, to make sure it's not completely generating nonsense. So besides the AI theme, three other kind of themes emerged from the conference that we wanted to share with our listening audience. First is the notion of national security and how a particular company might impact or sort of be a part of generating a higher level of national security, and then thinking about that from an investing perspective, right? So, think beyond sort of defense spending, issues like energy security, issues like raw materials, right? I mean, particularly you see these conversations about the rare earth materials and how we can make sure that we're controlling appropriately our share versus China, which is kind of controlling a whole lot of them right now. And, toss in, supply chain security, things like that. And you begin to see that companies that provide a role in securing those for our country might very well find themselves more valuable as a result of the role that they play. So I thought that was kind of interesting to, maybe think about sort of a national security overlay when it comes to thinking about the types of companies to own as an investor. Second is all this conversation about using private credit, private equity, and making those areas of investing available to the general public. That whole conversation clearly at a fever pitch. We've talked about this on prior shows, and frankly, we'll probably talk about it on future shows as well because the issue's not going away. But just to kind of recap our overall view on that, look, the reality is that when you invest in private credit or private equity, you're basically doing a business with a company that is not publicly traded, right? Hence the notion of it being private, not public. And so in that regard, you don't have the same level of liquidity because it's not publicly traded. It's private, so you can't just say, oh well, today I want to sell out of this stock position or this bond position or whatever the case may be. It doesn't work that way if it's private. There's definitely a lack of liquidity, and then to a certain extent, the disclosure, if I'm a private company, has a tendency to be a bit more opaque than the requirements for, say, a publicly traded company. And so against that backdrop, the difference between public versus private, the other interesting thing is that the market within the private area is pretty significant. Private credit markets, it's estimated that private credit markets, so that's lending to a private company from whether that be a bank or other kind of lending institution or financial institution, or a individual or pension or hedge fund or whatever the case may be. That market, it's estimated to be like 10 times greater than the public credit market. So it's a much bigger market. And so, when financial firms are out there kind of looking for, hey, we need some resources because, everybody wants to borrow money. Certainly the general investing public has a lot of resources. And so you see this push into that area to allow, if you will, the general public to start to get involved in that. And again, obviously big conversation, not one that's going away anytime soon, but the issue that we have with it, as we've said previously, is that, look, there's generally no track record there, and certainly the lack of liquidity puts that category of investing sort of what we would consider to be outside the bounds of what we would generally recommend to our clients. And so that is our position, but know that there's going to be a lot of conversation here, a lot about this over the course of the months and in years ahead. And then number three, and this one's, I guess, somewhat related back to the AI stuff. As an investor, you need to be particularly careful with your investment allocation. What we're seeing more and more of is that if we think of value funds, so value funds, traditionally dividend-paying funds, those funds are meant to serve a very important role in your portfolio when you have them, to sort of offset these more growthy, these more techie types of funds. So if you think of it as value funds sitting on the other side of the growth and tech funds, the notion, and after all, this is part of being diversified, is that you have a balance between those two, right? Otherwise, you wind up being concentrated, less diversified, and obviously creating more risk. Well, the problem is that more and more of these value funds, in order sort of to keep up with the returns that you're seeing on the growthy side, some of these value funds are what we would describe in the business as effectively cheating, meaning that they're owning some of those more growthy names that at the end of the day, you got to be careful with that. So it's important for investors to really dig deeper into their investment accounts, and rather than just say, oh, I got a value fund, I got a growth fund, that's great. You got to really take a minute to dig a little bit deeper into what are the types of names that value fund is holding, because if it's some of the same exact names that are on the large growthy side, then you're not really getting the diversification that you think you are getting. So certainly from an investor, that's probably one of the key takeaways as well, that you certainly need to be aware of when it comes to the investment allocation. So that's kind of the perspective. Obviously, a lot to kind of share, and so we appreciate you kind of staying through the first half of the program to kind of get through all of that information. Back half of the program coming up after these messages. We're going to talk about required minimum distributions, ladybird deeds, all that good stuff. So stay tuned for that here on Dollars and Cents with Joel Garris of Nelson Financial Planning. And the end of the year is fast upon us. You got all the holidays coming up, so it's easy to get distracted, right? And one of the things, if you get too distracted, you may miss taking out your full amount of your required minimum distribution. That becomes a big uh-oh moment because there's a significant penalty that still applies if you do not take your required minimum distribution. Now, the only good news about this penalty is that it's not as high as it once was. It used to be 50% penalty on the amount that you should have taken out but didn't. The good news is it's now down to 25%. So a little bit better, but still that's expensive. Plus, remember, because this is a required minimum distribution from a retirement account, guess what? You got to also pay taxes on that as well. So a lot to contend with when we think about the required minimum distribution. So certainly it's important to understand this and to understand, kind of how it all relates, why it matters, and sort of what the requirements are that involve the required minimum distribution. And then we're also going to talk about some of the strategies to sort of help manage the taxes as well. So for those of you who don't know, required minimum distribution is a minimum amount, as the name suggests, that you must withdraw every single year from certain retirement accounts once you reach a specified age. So whether that's an IRA or 401k or similar types of retirement plans, you've got a required minimum distribution. You also have a required minimum distribution if you inherited one of those types of accounts as well. The goal of why there is a required minimum distribution is the notion that that money that is in that account has been sitting there, never having paid any taxes, all of the growth happening on a tax-deferred basis, and the folks in Washington, well, they need your money. So the required minimum distribution rule was intended to sort of force people to take money out of those accounts, and when they do that, then voila, you have to report and pay taxes on that. Now, as we mentioned at the top of the segment, pretty steep penalties if you don't do it, which is why we're talking about it on the program. Make sure you don't get lost in the holidays and forget your required minimum distribution, because that is pretty significant in terms of now that 25% penalty plus taxes as well. Now, the reality is that we see a lot of concern or a lot of fear about the required minimum distribution and its impact. Let me get this on the table right now. For the vast majority of people that are retired, vast meaning well in excess of 80-85%, you're satisfying your required minimum distribution by virtue of the fact that if you're retired and taking income out of your portfolio, then you're probably covering your required minimum distribution, because the required minimum distribution isn't some giant amount of what you have to take of your account. It typically works out in terms of the math to be about 3.65%. That's kind of like the percentage that it starts out. So if you're following kind of the general rule of, I'm taking out 4% from my accounts or 5% from my retirement accounts, and that's generating the monthly income that I need in retirement, well, then congratulations. You don't have anything to worry about. You're taking out enough to cover it. Far too often we see these conversations that are really intended to generate a lot of fear that you're somehow missing something or not doing enough. The reality is that for most people, you will find that they are satisfying their required minimum distribution just by virtue of being retired and taking money out of their investments at the end of the day. Now, certainly the age, and I guess this is where another part of the confusion comes into play, certainly the age has changed. It used to be 70 and a half when you had to start to take that required minimum distribution. The first Secure Act changed that to age 72. The most recent Secure 2.0, which was enacted in 2022, increased that age to 73. And in fact, if you were born 1960 or later, your required minimum distribution age is in fact 75. So definitely have had some change in the years. The calculation pretty straightforward. You take the balance at the beginning of the year, divide it by your life expectancy factor that the IRS gives you in the tables, and poof, you've got your required minimum distribution. Now, the reality is that there is tax liability. So this is what we wanted to spend kind of some time on talking through with you all on the program. So one of the things that you can do to offset that tax liability is, because this is a distribution out of a retirement account, what that means is you can usually ask for a certain amount of tax withholding. So you get to have taxes withheld directly from that distribution. So let's say your required minimum distribution is $10,000. You could say, well, you know what, I want 15% withheld for taxes. And then what happens is that when you do that, $1,500 goes off to the IRS. You wind up with $8,500 deposited into your checking account. And so that helps to offset the tax liability of that required minimum distribution. And that's something that you probably want to do, because the reality is this thing is in fact taxable. So, but again, to really dial it in, you want to review your overall tax situation and make sure that, wait a minute, I'm having to pay taxes at 22%, or I'm having to pay taxes at 12%. Obviously, there's a big difference in those numbers. So if it's a $10,000 distribution, you could be $1,000 short in terms of the taxes, and then have to deal with that come April. So make sure you correlate the amount of tax withholding that you're doing to what your actual tax situation looks like. So that's kind of number one. Number two, if you are at all charitable minded, and we cannot stress this enough, the qualified charitable distribution route is a phenomenal way to go that ultimately allows you to make the payments directly to the charity. You can't take the money and then write the check to the charity. You got to have it go directly to the charity from your IRA. But what that does is that immediately reduces the taxable amount of that required minimum distribution. So let's go back to that $10,000 example. Let's say every year you give a couple $100 to your church every month. And so you say, well, that's $2,400. I'm going to do that all in one shot. So sort of fund the entire year. And that's going to be $2,400. If you do that as a qualified charitable distribution from your IRA, then voila, you've only got $7,600 of that $10,000 that you would need to report on your tax return. So pretty powerful and valuable. You can actually donate up to $108,000 in a single year, and every year that number goes up a little bit in terms of these qualified charitable distributions. It is not actually to do a qualified charitable distribution. You don't have to be required minimum distribution age. You can, in fact, do that anytime after turning age 70 and a half. So that one still has the old age rule under the required minimum distribution. Lastly, you hear a lot about Roth conversions as a way to avoid your required minimum distribution. That seems to be all the rage these days. Look, the reality is that when you do a Roth conversion, you're gonna proactively pay a bunch of taxes, and that's fine depending upon what tax bracket you are in, but far too often that extra income winds up having a significant ripple on your tax return. It could make your Social Security more taxable. It could make you subject to a higher amount of premium that you need to pay for Medicare. So don't just jump into the Roth conversion pond thinking that that's somehow going to solve your required minimum distribution. The reality is, as we said, for most people, if you're taking normal income out, you're kind of solving it anyway. So why bother to pay in a bunch of extra taxes with a Roth conversion if you're already kind of tackling it anyway? Anyway, we're going to wrap it on up and take a break. We'll continue after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Hey, before we get to the Ladybird Deed in our last segment here of Dollars and Cents, I want to take a sidestep. Usually I do this at the beginning of the program, kind of talk about current headlines, but we were talking about a lot about some of the takeaways from the conference that we recently went to in Washington, D.C. So hopefully you had an opportunity to kind of listen to that. If not, you can always check it out on any of our podcast platforms where you can hear the entire episode and our discussion about AI, the role of national security, the push into private equity, private credit, and then most importantly, sort of knowing what it is that you own. A lot of these value funds these days are starting to cheat with some growth names in order to kind of juice the performance. that's fine. But if you're looking to have a diversified portfolio, you might want to take a moment and make sure you know what you own as it relates to the underlying holdings of the funds that you have. The other thing I wanted to mention, of course, is that here we are mid-October, and the backdrop, particularly to this week, is, of course, earnings season once again is upon us. This is the time of year when companies announce their revenue and earnings for the third quarter and give guidance for the road ahead. And the start's been pretty good. Corporate America still continues to fare pretty well. And to show decent health despite the usual host of headwinds. Here are the stats for the initial start to earnings season, so day one. Actually saw 39 of the first 43 stocks reporting numbers that showing that those numbers exceeded consensus analysts' earnings estimate. And certainly as the earnings season has continued to progress, that strength has continued. In fact, over 80% of companies that are reporting sort of overshot their earnings estimates this past week. And it certainly was a full week. About 20% of the companies in the S&P 500 reported. So yeah, corporate America continues to move forward, I guess, probably with the efficiencies of AI at play, helping to be able to do that. But speaking of things that can help you much more immediately than AI, and much more practically, I guess, is we want to talk a little bit about kind of ladybird deeds and sort of their role in estate planning. So if you own a home or you own real estate and you're looking to make things easier after you pass, this is kind of the topic that we're diving into, this notion of a ladybird deed, which is certainly a powerful legal tool that you can use with respect to real estate that can save you time, money, stress, all of those kinds of things. So we'll start with the basics, as we always like to do. What is a ladybird deed? It's also known as an enhanced life estate, whereby or an enhanced life estate deed, whereby the ladybird deed is in fact a legal document that allows you to transfer the ownership of your property to someone else, but obviously with a big twist. That transfer of ownership to somebody else will only happen after you are dead and gone. So you keep full control of your house during your lifetime. You can live in it, you can sell it, you can mortgage it, and you don't need anybody's permission to be able to do that. So it looks and feels and acts just like you own your own home. But a ladybird deed then allows you to put on what in essence is a beneficiary that will automatically own that property when you pass without having to go through the probate process. Think of it like putting a transfer on death or a payable on death that you may put on an investment account or a bank account or something like that. Basically, that's kind of the same concept, except you're putting it on the deed for that particular property. So that's kind of the background of what it is and what it accomplishes. Where the name came from, it's ascribed to former First Lady Lady Bird Johnson. Apparently she used this approach out in Texas, and so the name is sort of stuck. It is state specific, so states like Florida, for example, or Texas, and certainly other states as well, allow for this option, but it is state specific. So if you have property in another state, we encourage you to kind of make sure that you can in fact use this approach. Obviously consult with a local attorney. So ladybird deed, obviously very powerful. As we mentioned, it avoids probate because in essence your property is going to pass directly to the beneficiary that you've named, skipping the entire lengthy and costly court process. It gives you the flexibility because, look, you are still the owner. The beneficiary has no say. This is not like a traditional life estate where the beneficiary is a remainderman and ultimately has a fractional interest or a fractional share in that property. So if you wanted to sell it, you would need to get their signature. If you wanted to mortgage it, you would need to get their signature. That's not how a ladybird deed or an enhanced life estate works. You still maintain the fullest amount of control over that property. So you don't need anybody else to sign off on stuff. So that's a key difference, if you will, in terms of how that all works. Now, how do you do it? What do you do? Well, the process is basically form-based, where you would get a form of a ladybird deed for your particular state that you're in. You fill out the deed, you name the person specifically on that. You make sure you include the proper language involving it being an enhanced life estate and not just a regular life estate, because again, if it's a regular life estate, then the beneficiary, the remainder person, could potentially then have ownership interest in it that you would have to accommodate if you wanted to do something with the property. So again, the ladybird deed, the enhanced life estate, kind of eliminates all of that. Obviously, because it's a deed, you sign it, you notarize it, and then you file it with the county, pay the proper, pay the, recording deed, the recording expense, all of those kinds of things. Here's the thing in Florida. And it's important to recognize this. Here in Florida, we have, homestead. So if this is your primary home, then one of the things that you want to do is you probably want to go through the process of refiling that homestead, because sometimes a ladybird deed, that's a change in deed, a change in registration, and sometimes that can trigger the removal of that homestead exemption. Not a big deal so long as you go back through that process of refiling your homestead. So know that here in Florida, that's a little bit of the twist in terms of kind of how that ladybird deed ultimately works out. But certainly in compared to probate, it is a much better process. With the ladybird deed, the process of transferring title becomes, almost instantaneous. You don't have to go through a long, drawn-out court process. Correspondingly, that keeps the costs down, because obviously going through a court process comes with money, and then the control. During the course of your lifetime, you still have full control over the property. So certainly ladybird deed, that's kind of the background on what it is. It is considered an enhanced life estate, different from a life estate in that the remainder or the beneficiaries don't have any direct ownership interest in it. That's the key distinction. Certainly you want to, if you're using it, you want to use the right language in order to ensure that ladybird deed is able to operate effectively, so that when you pass, then it automatically goes to the named beneficiaries. And when it does that, it operates just like a payable on death or a transfer on death would occur on a bank account, whereby it goes automatically, show the death certificate, sign your name, and it's instantly moved over into that beneficiary's name. So a pretty powerful technique. There is a court process where you got to file it. And then here in Florida, make sure you pay attention to the homestead thing too, because sometimes our experience is that, you got to go back and refile that homestead. So with that, we're going to start to wrap it on up and get on out of here. This has been another edition of Dollars and Cents with Joel Garris of Nelson Financial Planning. Any questions about anything that we talked about on the program, feel free to reach out to us, courtesy of our website at nelsonfinancialplanning.com. While there, you can always schedule an absolutely free conversation with one of our certified financial fiduciaries to see how we can help you make better decisions with your money. With that, we're going to wrap it on up and get on out of here. Thanks for listening to the program. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.